Welcome to Understanding Credit Scores, which is the first of 3 videos provided by Advantage Credit. Now, the first question you may ask is, what is a FICO score, or better yet, who is FICO? And in 1956, Bill Fair and Earl Isaac founded Fair Isaac Company, or FICO, on the principle that data, used intelligently, can improve business decisions. Well, in 1995, Fannie Mae and Freddie Mac recommended use of FICO scores for evaluating U.S. mortgage loans. You may ask, well, who is Fannie Mae and Freddie Mac? Well, they were established to provide local banks with federal money to finance home mortgages, to raise levels of home ownership, as well as the availability of affordable housing. Now, the foundation of FICO scores is really based on a simple philosophy: the likelihood that you will repay your debt on time, or the willingness that you will repay your debt. Now, the FICO score ranges between a low of 300 to a high of 850. Obviously, the goal is to get your FICO score as high to 850 as possible. Most lenders will provide excellent rates in financing if your FICO scores are in the high 700s or low 800s. Now, a credit report, when pulled on you and your FICO scores, keep in mind, are a snapshot at that given moment. So if you make your payments early, or if you just made a payment recently on a credit card, there's a possibility that they may have not showed up on your credit report. So keep in mind that if you're going to apply for a loan, you want to make sure you pay off your debt weeks prior, so your creditors are reporting that information correctly. Now, there are different scoring models, even though they're all called FICO. There is a mortgage FICO score, a credit card or consumer FICO score, as well as a FICO score for automobile loans. So if you apply for a car loan today, chances are that FICO score may be higher than if you applied for a mortgage FICO or for a mortgage loan that very same day. Mortgage FICO scores are usually looked at with more stringent guidelines. They're looking at many other factors, and in most cases, your mortgage FICO score is probably going to be the lowest at that given moment. Now, what makes up your credit score is consisting of these different factors listed here on the pie chart. And as you can see, over 50% of your FICO score is based on payment history, as well as the length of that payment history. So it's very important, as you pay off credit cards, do not close them, so that way that payment history continues to be counted towards your FICO score. Once you close an account, a credit card, a mortgage, an installment loan, that payment history is no longer factored into your FICO score. So by closing accounts, sometimes that actually can lower your FICO score. Now, the other factor is balances, and that's balances makes up 30% of your FICO score. That's balances on credit cards, home lines of credit, lines of credit. And that 30% means something else. If you're preparing to apply for a loan, your goal should be is to have your credit cards, lines of credit paid down to 30% of the high credit. So if your credit card limit is $1,000, your goal should be is to have those balances at $300 or less. And by doing so, that will have the greatest impact on having a higher FICO score. Now, in the mortgage industry, mortgage FICO scores also take into consideration what we call is the healthy credit mix. And they look at these 4 factors. They'd like to see at least 2 installment loans with balances. So a mortgage, a car loan, a student loan, something with a fixed term, fixed payment. And also a minimum of 3 revolving debts: credit cards, lines of credit, home lines of credit, and again, with balances at 30% or less of a high credit. And then, of course, the obvious: no derogatory items, no collections, late payments, etc. And then it's okay to have additional credit cards on top of the above with long payment history that maybe you use once every 2-3 months, and you pay them off and keep those balances close to zero at all times. Having that perfect, healthy mix of credit is very critical today to achieve that high mortgage FICO score. Now, we are often asked, how long do delinquencies or derogatory items stay on your credit report? And as you can see by listing all of these consistently, they're all at least 7 years, if not longer, that they will remain on your credit report. Now, one that stands out that's a little misleading is tax liens. If you've had a tax lien in your credit report for 3 years and then you pay it off or satisfy it, that is when year 1 starts from the date of satisfaction. So in that example, that tax lien would be on your report for 13 years. Now the next question would be once one of these derogatory items shows up on your credit report, how much would that impact my FICO score? Well, Fair Isaac Company shared some recent information on the most common credit mistakes people make. And as you can see, just one 30-day late payment could potentially lower your score anywhere from 80 to up to 110 points. I tend to call this the taller you are, the harder you fall slide, because the higher your FICO score, the chances are your score is going to drop more based on these different items. Such as if you max out your credit card or exceed your credit limit, your score could drop by as much as 30 to up to as high as 45 points. If you have a charge-off, a collection, or a foreclosure, or worse yet, if you have a bankruptcy, your score could drop by as much as 240 points, especially if they have that high FICO score. Now, I do have good news on this slide. Once one of these items has showed up in your credit report and it is over 2 years old, it's probably having a minimal impact on your FICO score. So if you have a late payment that's 2-3 years old, don't panic, don't worry about it. If you've reestablished good payment history, chances are it's not affecting your FICO score anymore. Now, there are 4 very simple things to live by as far as keeping that high FICO score. 1, don't open new accounts unless you have to. If you already have that perfect healthy mix of credit, we recommend do not open additional accounts, or that may lower your score initially until you reestablish payment history. And of course, don't close those accounts you've had long payment history on, because that's really having a big impact on your FICO score in a positive way. Keep that revolving debt to a minimum, which is around 30% or less of the high credit, and then pay your bills on time. I encourage you to view the other videos, one called Improving Credit Scores and Avoiding Identity Theft, and also Industry Trends Impacting Credit Scores. I hope you found this information helpful, and thank you for viewing Understanding Credit Scores.